Money, it touches every single one of us, shapes our choices.
Everything, yeah.
And yet, for something so, central, it really does confuse the heck out of most people.
It absolutely does. And we
Yeah.
often treat it like physics,
Yeah.
like there's these hard and fast rules. If I do X, Y will happen,
Right.
predictable. But the material we're looking at today argues pretty convincingly, I think, that it's much, much more like psychology. It's messy, it's emotional, full of these unseen forces.
Exactly. Which makes it, and I love this phrase from the source, one of the greatest shows on earth for actually understanding why people behave the way they do.
It's a window into human nature, isn't it?
Totally. So this deep dive, it's all about exploring that human side, the psychology of money, using the insights from this material.
Yeah, we're going to try and pull out the really important nuggets.
Our goal here is really to help you, the listener, look at your own relationship with money and maybe how others handle it with some fresh perspective. Understand why people do seemingly crazy things, grasp luck and risk, figure out what enough actually means, see the quiet power of compounding and how history kind of shapes where we are now.
That's a lot to cover. Starting with maybe the most generous idea first, why no one is crazy.
Yeah, which sounds kind of wild, right? Because we all see financial decisions that just seem baffling, maybe even destructive.
You immediately think, what were they thinking? Are they crazy? And the sources say, well, hold on. The idea is that everyone's view of money is built on their own, totally unique set of experiences.
Where you grew up, your parents, the economy, when you started working, all that stuff.
Exactly. Your generation, income level, where you live, the luck you've had, good or bad, all these things build your personal money filter.
And here's the real kicker from the material. Your personal experience, it's maybe, what, 0.000000001% of all financial history.
Globally, it's basically nothing, a tiny sliver.
Right, but that tiny sliver feels like maybe 80% of how you think the world works financially.
Yeah, that's your reality.
Yeah.
So you can have two smart people given the exact same data.
And they'll reach completely different conclusions.
Because their starting points, their emotional understanding based on their history, are just fundamentally different.
There's a great example in the source material about JFK and the Great Depression.
Oh, right. He basically admitted he had no firsthand knowledge of it.
His family was so wealthy, they were insulated. Their fortune actually grew relative to others during that time. He just saw it from afar.
So this massive event that scarred a whole generation financially.
Was something a future president only really learned about by reading books?
Exactly. And you can read about it, you can study the charts, but you can't, download the feeling, the emotional scar tissue of actually living through losing everything.
Someone who went through the 30s is just going to react differently to a market dip than someone who's only ever seen markets bounce back, right?
Absolutely. Which means these decisions, they aren't just math problems on a spreadsheet. They're made by real people, dealing with their past, their ego, pride, what the neighbors are doing, all of it.
Yeah. Think about the example of someone with a really low income buying lottery tickets. Statistically, terrible idea.
The math is awful. Looks crazy from the outside.
Totally.
But if you try to see it from their perspective, as the source suggests, maybe someone with very few paths forward where saving feels impossible and affording things like a decent car or a vacation seems like a total fantasy. That lottery ticket isn't just about the tiny odds.
It's buying hope, a dream.
It's paying for the possibility, however remote, of a different life. You're buying the dream of having what others maybe take for granted.
So you don't have to agree with the choice.
No. But you can understand why it might make sense to them in their specific situation. That's the shift from judgment to trying to understand the why.
That really does reframe things. Okay, so from our personal filters, let's zoom out to luck and risk. The material calls them siblings.
Yeah, they're closely related. And they're these huge forces that we often, underestimate when we look at why things turned out the way they did.
Success and failure are rarely just about how hard someone worked, are they?
Not entirely. There's that line from Scott Galloway mentioned in the material, nothing is as good or as bad as it seems.
That sticks with you.
It really captures it.
Yeah.
Think about Bill Gates. Obviously brilliant, driven.
Sure.
But there's this massive element of luck. He happened to go to Lakeside School in 1968, one of the only high schools anywhere with a computer back then.
Just incredible timing and access.
Pure luck. And the material contrasts him with his friend Kent Evans, who was just as smart, apparently, but died in a climbing accident before they really got going.
Wow, one got the lucky break, the other didn't.
Right, so if you only focus on Gates's skill, you miss that crucial piece of luck, the school, the timing, even Evans's tragic fate.
And that's why just copying successful people doesn't always work.
Exactly. Success stories often, gloss over the luck involved.
Yeah.
So it's hard to know what was repeatable skill versus just being in the right place at the right time.
Like, was Cornelius Vanderbilt bold or just reckless and lucky he didn't get caught breaking laws?
Or Benjamin Graham's huge Jaico bet. Was that pure genius that broke his own diversification rules or incredibly fortunate timing? The line is really thin.
So remembering luck helps you stay humble when things go well.
It absolutely should. Because if luck helped you succeed, bad luck can just as easily trip you up. Nothing's that amazing, and maybe nothing's that terrible, because you can't control all those random factors.
Humility. That seems to be a recurring theme. Okay, speaking of staying grounded, let's talk about knowing when you have enough. Sounds simple, but
Oh, it's incredibly difficult in practice. The story about Kurt Vonnegut and Joseph Heller is perfect.
on Shelter Island, right?
Yeah. Vonnegut points out their host, some hedge fund guy, made more money in a single day than Heller earned from his masterpiece, Catch-22, over its entire lifetime.
Yeah.
And Heller just says, yes, but I have something he will never have. Enough.
Enough, just setting that boundary.
It's so powerful. And so many fail to do it. Look at the story of Rajat Gupta.
The McKinsey CEO.
Yeah. Raised from nothing, incredibly successful, retired with something like $100 million.
Which is definitely enough by any sane measure.
You'd think. But he wanted to be a billionaire. He risked absolutely everything, his reputation, his freedom, all that money he had for something he absolutely did not need.
Chasing billions through insider trading.
And ended up in prison. The lesson is just so stark. There is no reason to risk what you have and need for what you don't have and don't need.
Seems obvious when you put it like that.
But it's maybe the hardest financial skill, stopping the goalpost from moving. The real danger is when your ambition keeps growing faster than your satisfaction.
You make more, but you don't feel any richer because enough just jumped ahead again.
Exactly. And social comparison pours gasoline on that fire. You see your neighbor's new car, or read about Mike Trout's contract, or some hedge fund manager's bonus.
Someone always has more.
Always. It traps you on this treadmill of wanting more, more, more.
Can you forget what actually matters?
Right. The material lists things you should never risk, no matter the potential gain. Reputation, freedom, family, friends, happiness, those are the real measures of having enough.
That really puts money in its place. Okay, switching gears a bit, let's talk about something that feels almost like magic. Compounding.
Ah, yes. The eighth wonder of the world, or so they say.
Uh,
It really shows the power of time.
It's just simple math, right?
Yeah.
Repeated over and over.
That's all it is. But the results over long stretches, they're counterintuitive, just astonishing. We get so obsessed with finding the absolute highest return each year.
Yeah, beating the market.
But the sources argue pretty strongly that time is the real superpower here. Look at Warren Buffett versus Jim Simons.
Buffett's returns are great, like 22% annually over, 70 years? Simon's are way higher, like 66% a year since the late 80s.
Simons' rate is vastly better. But Buffett is immensely wealthier. Why?
Decades more time.
Exactly. He had decades more for that compounding to just run wild. It shows that sticking around, just staying invested, letting time do its thing, is often more powerful than hitting home runs every year.
So the best investment strategy isn't necessarily being the smartest stock picker.
No, the material jokes that the best investing book might just be called Shut Up and Wait, with a long-term growth chart on the cover.
I like that.
The key is earning pretty good returns that you can actually stick with consistently for a very, very long time. That's where compounding really takes off.
Patience beats perfection.
That's a good way to put it. And that distinction leads right into the next point. Getting wealthy versus staying wealthy.
Apparently they're different skills.
Very different. Getting wealthy often takes some risk, maybe some boldness, seizing opportunities. But staying wealthy, that requires a different mindset entirely.
Tell us about Jesse Livermore again.
Legendary trader. Made an absolute fortune betting against the market in the 1929 crash. Genius timing.
While others were wiped out. Like Abraham Jermansky.
Right? Jermansky, the real estate guy, lost everything, just vanished. Livermore knew how to profit from disaster, how to get rich. But within just a few years, he got overconfident, made bigger and bigger bets, more reckless ones, lost it all, died broke.
Wow. So the same skills that made him rich ultimately ruined him.
It highlights the paradox. Staying wealthy needs humility, a bit of fear about losing it, prudence, acknowledging luck. Sort of the opposite of the confidence and risk-taking that might have gotten you there.
Like Michael Moritz at Sequoia Capital saying, only the paranoid survive.
Exactly. He said their long success came from always being a little bit afraid, never getting complacent. Survival is the name of the game.
Because if you survive, you get to keep compounding.
You got it. Avoiding the big mistake, the one that takes you out of the game, is way more important than trying to maximize every single game.
Charlie Munger said something similar about Rick Guerin, right? Their old partner.
Yeah, Munger said Guerin was just as smart as them, but he didn't reach the same heights because basically he was in a hurry. He took too much risk, likely using leverage, and got caught.
Patience again, not being in a rush.
It ties into having a margin of safety or room for error.
Which isn't just about being super conservative.
No, it's about building buffers into your finances in your life. Having extra savings, flexible timelines, not being leveraged to the hilt. It's designing things so you can withstand shocks.
So when the unexpected happens, and it always does,
You don't get forced into a terrible decision. You can survive, stay invested, and let compounding do its work over the long term. Survival is the bedrock.
Okay, speaking of unexpected things, let's talk about tail events. These outliers.
Yeah, the extreme events. They're responsible for most of the really big results, good and bad, in finance and business. The vast majority of things are just, meh, or they failed.
It's the extremes that drive the averages, like that Russell 3000 stat.
Right? Something like 40% of the companies in that huge index basically went bust, worthless.
40%.
Yet the index overall delivered fantastic returns. How? Because a tiny fraction, maybe 7% of the companies, were monster winners, home runs, and those few huge successes more than made up for all the failures.
So success is really concentrated in a few big wins.
Totally. Which is why people like Jeff Bezos or Reed Hastings are okay with big failures. Bezos talked about the Fire Phone failure being small compared to other bets they were making. Hastings wanted Netflix's failure rate to be higher, meaning they weren't swinging for the fences enough.
They get that you have to accept a lot of misses to hit those occasional grand slams, those tail event successes.
And that applies to your own portfolio, too. Warren Buffett owned hundreds of stocks, but a huge chunk of his wealth came from just a small number of big winners. It's okay to be wrong a lot.
As long as you're right big when you are right.
Exactly. George Soros put it perfectly. It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong.
That changes how you think about diversification, doesn't it? You don't need every pick to be a winner.
Not at all. Now, let's pivot slightly. What's the absolute best thing money can buy you?
We already ruled out the fancy car.
Right. The material argues, very persuasively I think, that the highest dividend money pays is control over your time.
Ah, that resonates. The freedom to choose.
Yeah. Research backs this up. People chase wealth, often thinking it'll bring happiness directly. But what consistently does boost happiness across all kinds of people is feeling in control of your own life.
Being able to decide what you do, when you do it, who you do it with.
Where and for how long. That autonomy. The story of Derek Sivers is great here.
Saving the $12,000?
Yeah. He was in some basic job, saved up just $12. But that was enough for him to live on for a bit. And that buffer gave him the freedom, the control to quit and pursue music full time.
And he said later, after selling his company for millions, that the millions didn't change his life as fundamentally as that first $12K did.
Because the $12K bought him the core thing. Freedom, control over his time. The rest was just more.
The sources also make an interesting point about modern jobs, like knowledge work.
Right. Compared to, say, factory work in the 1950s. Back then, you clocked out, work stayed at the factory, your time was yours.
Now our work is in our heads, and our heads are always with us. Email, Slack, just thinking about projects.
It bleeds into everything, commuting, dinner time, weekends. We might be richer materially than people in the 50s.
But if we have less control over our own time, are we actually happier?
That's a good question. And the material ties this to regrets people often have later in life, wishing they'd spent more time with family and friends, using money to buy back time, to gain that control. That aligns directly with avoiding those deep regrets.
Using wealth to buy autonomy. That's powerful. Okay, this leads nicely to the man-in-the-car paradox. Wealth is what you don't see.
Yeah, this one's fun. It tackles why people often want visible wealth. For status, admiration.
The Ferrari, the mansion, the Rolex.
Exactly. But here's the paradox. When you see someone in a Ferrari, You probably don't think, wow, that driver's cool.
No, you think, wow, if I had that car, people would think I'm cool.
You're admiring the car and imagining yourself in it, not admiring the person driving it.
Yeah.
The source uses the valet example.
Seeing all these fancy cars driven by people who might just be spending a huge slice of their income to look rich.
And the core idea is simple. Spending money to show people how much money you have is the absolute fastest way to have less money.
Because real wealth isn't the stuff you buy.
No. Real wealth is the money you didn't spend. It's the savings, the investments, the assets working for you quietly in the background. It's the flexibility and independence you've built up, which is usually invisible.
And if you actually want respect and admiration.
The material suggests, maybe try kindness and humility first. They tend to work better than a flashy watch.
Good advice.
Yeah.
Okay, let's talk about the foundation of building that invisible wealth, the importance of saving money.
Sounds so basic, right? Save your money.
Almost too simple.
And maybe that's why it gets overlooked. People focus on earning more or finding the next big investment, but the sources argue that building wealth has way less to do with your income or your returns and way more to do with your savings rate.
Just the percentage of your income you manage not to spend?
That's it. Wealth is just the leftovers. You can absolutely get wealthy on a modest income if you save a large portion of it, but you have basically zero chance, even with a huge income, if you spend it all.
Lifestyle creep just eats everything.
Totally. And saving isn't just about the money growing. It has this hidden return. Flexibility. Options.
Being able to change careers, handle an emergency.
Wait for a good investment opportunity instead of being forced to sell low. It buys you breathing room.
And the idea of saving without a specific goal is interesting too.
Yeah, saving just.
Yeah.
Because saving for the surprises life inevitably throws at you. The job loss, the furnace breaking, the medical bill.
It's that margin of safety again.
It is. Saving for the unknown acts as a hedge against chaos. It lets you ride out the storms without wrecking your long-term plan, so compounding can keep going.
Okay, so we save. But how do we make decisions about saving and investing? This brings us to reasonable versus rational.
Right. Finance theory loves rational actors maximizing utility. But real people were usually just trying to be reasonable.
Meaning we're influenced by emotions, context, history, not just cold, hard math.
Exactly. The Harry Markowitz example is brilliant.
The Nobel Prize winner for portfolio theory.
The guy who literally invented the math for optimal portfolios. But for his own retirement, he just split it 50-50, stocks and bonds.
Why?
Not because his math said so, but because he felt it minimized his potential future regret. It was the mix he could psychologically handle, sleep well with. It was reasonable for him.
Because decisions aren't made in a vacuum. You're talking with your spouse, seeing what friends do.
There's a huge social and emotional overlay that pure financial models just ignore. Being reasonable might mean, investing in something you're passionate about, even if it's not perfectly optimal, because that passion helps you stick with it.
Or maybe having a tiny fun money account for trying things so you don't mess with your main long-term plan.
Exactly. It's about finding strategies that work for you as a real emotional human being, strategies you can actually maintain over time.
Okay. Now, let's look at something that definitely plays on emotions. The seduction of pessimism.
Oh, yeah. Bad news just seems to grab us more, doesn't it? And pessimism often sounds smarter.
More insightful, maybe. Like you see the flaws others miss.
Right. Optimism can come across as naive, like you're ignoring the problems. But the sources define real optimism differently.
It's not thinking everything will be perfect.
No. It's believing that over the long run, despite all the setbacks and challenges, the odds favor progress and good outcomes. It's faith in ingenuity and that slow upward grind of improvement.
So why are we so drawn to the negative?
Probably evolutionary. Loss aversion. Our brains are wired to pay way more attention to threats than opportunities. A potential loss demands action. A potential gain can wait. Survival instinct.
Like the Wright brothers example, they flew and crickets, mostly.
Yeah, for years. People were so convinced it was impossible that success didn't register. But failures, they get headlines immediately. Progress is slow, it compounds quietly. Failure is often fast, loud, and dramatic.
It's just easier to tell a compelling story about a specific failure than about slow, incremental progress.
And there's an odd comfort sometimes in expecting the worst, right? If things turn out even slightly better, it feels like a win. But that mindset makes you miss the huge upside of long-term compounding growth.
Which connects to another psychological trap, believing appealing fictions.
This is when we desperately want something to be true, especially when the stakes are high and we feel powerless. We latch on to stories that confirm our hopes, even if the evidence isn't there.
The story about the Yemeni father is just gut-wrenching.
It really is. His son is desperately sick. He has no money, no access to real medicine. He said, when you have no money and your son is sick, you'll believe anything.
So he tries some harmful folk remedy.
Because he needed to believe something could work. The desperation made him grasp at that fiction. You saw this all through early medicine, too. Leeches, weird concoctions people believed because they were desperate for hope against disease.
And this applies to finance, too.
Absolutely. We all have narratives in our heads about how money works, how the economy works. Sometimes these are based on wishful thinking, especially when we want something badly, like getting rich quick without risk. We believe the appealing fiction.
It's a reminder to question our own assumptions, especially the ones that feel really comfortable or hopeful.
And those assumptions and hopes change. Which brings us to, you'll change.
Meaning, the person making the financial plan today isn't the same person who will be living with it in 20 or 30 years.
Exactly. We are notoriously bad at predicting our future selves. Our goals, our values, what makes us happy can all shift dramatically.
Like that friend mentioned who worked like crazy for a specific career goal.
Only to get there and realize the stress and sacrifice weren't worth it to his older self. His priorities had changed.
But compounding relies on sticking with the plan for decades. How do you do that if you keep changing?
It's tough. We might live life in distinct chapters, not one smooth line. So the material suggests avoiding extremes in your planning.
Don't commit to a life of extreme frugality forever or endless 80-hour work weeks.
Right. Because those extreme paths are brittle. They're hard to sustain when your priorities shift, increasing the odds you'll abandon the plan altogether, maybe with deep regret.
So aim for balance.
Yeah. Moderate savings, enough free time, reasonable work hours, time for other things. A balanced approach is more adaptable, more durable. It gives your future changed self more room to maneuver without blowing up the whole plan.
Balance enables endurance. Endurance enables compounding.
You got it. Now let's talk about what it costs to play this game. The price of success.
Because nothing good is free, right?
Not in finance, anyway. The price you pay for earning market returns isn't just fees or taxes. It's the emotional toll. Dealing with volatility, fear, doubt, uncertainty, regret.
That sick feeling when your portfolio drops 10%?
That's the price of admission. The problem is, it doesn't feel like a price. It doesn't have a sticker like a car payment. It feels like a fine, like you did something wrong because the market went down.
And people hate paying fines, so they try to avoid it.
They panic sell, they try to time the market, they chase safety that doesn't offer growth, they try to get the returns without paying the volatility fee.
But you can't, really. The GE example under Jack Welch fits here.
Perfectly. He famously smoothed earnings, trying to eliminate the short-term bumps for shareholders, gave them the illusion of return without risk.
But it wasn't real.
No. You can hide the price for a while, but eventually the bill comes due, and for GE, it came due in a big way later on. You can avoid the fee of market volatility.
By keeping your money in cash, earning next to nothing.
Exactly. Think of volatility as the entry fee to the theme park with the potentially exciting rides. If you want the chance at higher returns, you have to pay the price of the ups and downs.
Okay. Next up, bubbles are narratives about the future.
Right. Bubbles aren't always just mass hysteria. Sometimes they happen because different groups of people are playing completely different games, looking at different time horizons. Well, during a bubble, .com, housing, whatever prices get totally detached from any reasonable long-term value. Looks crazy if you're investing for 20 years.
Sure.
But if you're a short-term trader, playing the momentum game, that crazy high price might make perfect sense.
It's like buying Yahoo in late 99, planning to sell it higher next week, or flipping houses in Florida in '05.
Exactly. Your game isn't about intrinsic value. It's about guessing what someone else will pay tomorrow or next month based on the current hype. And money flows to where people expect returns, even if those expectations are built on a short-term fiction.
So people aren't necessarily irrational. They're just rational within their own short-term game.
That's a key insight. The lesson isn't just avoid bubbles. It's understand your game. What's your time horizon? And don't get swayed by the actions and narratives of people playing a completely different game than you are.
Know thyself. Know thy timeline. Okay, that's a ton of really useful psychological insights. Let's try to wrap this up by pulling out some core actionable lessons. The material is clear. We can't tell you exactly what to do.
because we don't know you, your goals, your risk tolerance, your situation.
Yeah.
But there are some pretty universal truths here.
Okay, first, humility and compassion. Be humble when things go well, recognize luck. Be compassionate when things go badly for you or others, recognize risk. Nothing's ever as good or as bad as it seems.
Second, less ego, more wealth. Save money. Suppress the urge to spend today for status and build options for tomorrow instead. Wealth is often what you don't see.
Third, sleep well. Manage your money in a way that lets you sleep at night. Find your reasonable approach, not someone else's rational optimum.
Fourth, buy time. Use money to gain control over your time. That autonomy is its highest and best dividend.
Fifth, be nice. If you want respect, kindness, and humility work better than flashy stuff. Seriously.
Sixth, just save.
Yeah.
Especially save without a specific goal. Save for the inevitable surprises. It's your best hedge against life's curveballs, and it lets compounding work.
Seventh, pay the price. Accept volatility and uncertainty as the necessary fee for potential long-term market returns. Don't treat it like a fine you can avoid.
Eighth, room for error. Build in margin of safety. It's not about being timid. It's about ensuring survival so you can stay in the game long enough for the odds to work in your favor.
And ninth, avoid extremes. In work, spending, saving, balance makes your financial life more durable because you will change over time.
Yeah, and the author shares their own approach as just one example. Moderate lifestyle despite rising income, building that independence fund, saving for the unexpected, and just consistently investing in simple, low-cost index funds.
Because their high savings rate means they don't need to be a genius investor. They just need to be decent and consistent, letting saving and time do the heavy lifting.
Exactly. And finally, the material touches on some important historical context for why, particularly in the U.S., we consume and borrow the way we do.
Right, the post-World War II shift.
Yeah. After the Depression and war, there was this big cultural push away from thrift and towards spending to drive the economy. Plus, things like the GI Bill made mortgages and consumer credit way more accessible.
And this happened during the Great Compression.
When incomes were much more equal than today, so people got used to the idea that most families could afford a somewhat similar middle-class lifestyle. That expectation got baked in.
But then, starting in the 70s, inequality starts rising sharply.
Right. The expectation of a similar lifestyle remained, but the reality of stagnant or falling wages for many meant the only way to keep up appearances, to reach for that expected lifestyle, was through debt.
So debt bridged the gap between the old expectation and the new reality of inequality.
Largely, yes. And this historical mismatch, the source argues, helps explain a lot of the financial stress and debt burdens people face now.
And even ties into broader social discontent.
It suggests a connection, yeah. Movements like the Tea Party or Occupy Wall Street reflecting groups who feel that old post-war promise isn't working for them anymore.
Wow. Okay, that adds another important layer. It really brings together the personal psychology and these bigger historical forces.
It really does. I think the big takeaway from all this is that understanding the psychology around money your own and just general human tendencies is maybe more important than understanding spreadsheets.
Seeing money not just as numbers, but as this reflection of our hopes, fears, biases, and history.
And using that understanding to build a financial life focused on what actually matters. Saving, patience, flexibility, humility.
Paying the price when necessary, and knowing what's truly enough for you.
So, maybe the final thought for you, the listener, is this. Considering how much our experiences in these background narratives shape us, what specific assumptions, what appealing fictions about money or the economy might you be holding on to right now?
And how might questioning those change your path?
Something to think about.